Good morning, Vanessa. Iria.
Good morning.
Morning.
Good morning, Bet. Well, you guys did good on the test, huh?
Yeah, it wasn't so bad.
No. Looks like we got the debits and credits under our belts. That's that's a major start. So
Good.
We'll just wait another moment or so. Justin normally doesn't miss a class, and a couple others, and we'll get going. In the meantime, I need to get a belt of my whiskey here. Ooh, it's good stuff. All right, I guess we can just get started. This could be the two of us today. My goodness. Let's see, let me share this. All right. Do you see the screen? Could somebody let me know? The PowerPoint?
Yep, we got it. We can see it.
All right, Rhea, here we go. Off we go. Accounting for cash, huh? Cash. That's the asset most likely to be stolen, huh? Who knew? Cash. What is cash? Cash is, currency and bills. It's the bills and coins in your pocket, checking accounts, checks from customers, money orders, bank issues, checks, drafts, direct deposits, credit cards. As far as I'm concerned, that's cash. Those are all cash items. Cash is such an important asset. It must be carefully managed and controlled. And we're going to talk a little bit about what's called internal controls. And what these refer to are the various policies and procedures a company has to ensure proper accounting for transactions. And good internal control for cash is especially crucial. All cash should be deposited daily. You don't want to leave money lying around your office. A lot of times you'll read a store, for example, or a fast food place gets robbed by a former employee who knows that they only put the money in the bank once a week, and he waits until that day. So depositing daily is a simple example. You want to pay with checks, obviously, rather than cash. Describe how to open and use a checking account. Do we really need to go over this? Probably not. Okay, the U.S. Patriot Act, clear identification. I'm not going to worry about the Patriot Act. I'm not going to worry about opening a checking account. I think our entire class has a checking account and they understand that. And you go to the bank and you fill out a signature card. Making deposits, a deposit ticket. We know what that is. You fill out the amount of the check. And there's an example of a deposit ticket. Let's talk a little bit about the types of endorsements. Endorsements, each check being deposited must be endorsed, meaning a signature on the back of it before it can be negotiated. The endorsement, it can be a stamped signature, or somebody writes their name on there, or something else. And businesses often use a rubber stamp. Different types of endorsements, and this is on the test. It's kind of these simple little things. A blank endorsement. A blank endorsement means the person cashing the check just signs his name on the back of the check. That's all it means. Once you sign the back of the check, it's payable to almost any bearer. So if you sign your paycheck at work and it falls out of your pocket on the way to the bank, any bum on the street could pick it up and possibly cash it. So typically you want to sign your paycheck at the bank, or most likely you're using direct deposit, which is an example of an internal control. A restrictive endorsement. Here's where you limit who can negotiate the check. The payee adds words for deposit only, pay to the bank, pay to Bob Smagula, hopefully. This restricts payment to a particular person. I was in the habit for years and years and years before the days of direct deposit of always writing for deposit only on my paycheck. Years ago, restrictive endorsements. You have a blank endorsement, restrictive endorsement. We have something called an ATM. You're probably not familiar with these, huh? An ATM. We know what an ATM is, automatic teller machine. And you're going to get a card, take money out. Writing checks. A check is a document ordering a bank to pay cash from your account. Now, for purposes of the test, they love to try to trick you with the difference between the drawer, the drawee, and the payee, okay? The drawer is the person who orders the bank to pay the cash. The drawee is the bank, and the payee is the person being paid the cash. The drawer is the person who's writing the check, in other words. Drawer draws the check. Drawer draws the check. The bank is the drawee and the payee. Three simple terms that invariably show up on the test. And in preparing a check, you fill out the check stub. And obviously, I'm skipping through this pretty briefly till we get to some good stuff. I'm sure you know how to write checks. Now we get into something good. The bank statement. The bank statement. At the end of the month, you get a bank statement in the mail, or they make it available online. And what that statement's going to do, it's going to show how much money you had at the beginning of the period. It's going to show how much money the bank says you have right now at the end of the period. And it's going to show in chronological order all of the deposits or additions that were made to your account and all of the subtractions in the form of checks and other items. And you might get the canceled checks back. That's pretty old fashioned. I don't think many people do that any longer. You can always see them online. So the bank statement is a crucial tool. And typical bank statement, if you're like most people, you probably don't even look at the bank statement. You might not even get a copy of it. You might have told the bank, don't worry about it. But for purposes of accounting, we have to know that the bank balance was so much at the beginning of the period, which you see here, 27/21/51, and there's your beginning balance. Here are all the deposits that were made, all of the reductions for whatever reason, to get to your final balance of 1780.09, which we see here in the upper right. So the bank statement, let's get comfortable with it. Nothing too terribly hard. Now we get into the good part. Here we go, the good part. Hi, Katie. We'll let Katie get on here. I like to get her involved. Hi, Katie. Katie's the one who can't talk to us. I was just saying, Katie, you came in at a good time. We're just starting with bank reconciliations. Book balance versus the bank balance. The book balance means the balance in our general ledger, the balance in our checkbook, okay? And what if we saw that our bank balance, the bank says we have $3,000, but our checkbook says we have 10,000. Is that a problem? The answer is probably not, because there is always going to be a difference between the bank balance and the checkbook because of timing. Checks are in the mail to the bank. Deposits are made by the bank that we don't know about, wire transfers perhaps. So on any given day, the balance in the cash account is not going to be the same as that of the bank. It can be due to errors, hopefully not, but it's timing mostly. Transactions generally recorded by the business at a time that is different when the bank records them. So we need to prepare what's called a bank reconciliation. And this is part and parcel of what we call internal controls. I would say the bank reconciliation is probably the most important accounting report you can put together. It helps you verify that your most important asset, cash, is under control. You're going to have differences between the bank balance and yours because of timing, checks in the mail. On July 31st, you deposited on July 31st, you opened your mail and you had 5 checks from customers. You entered those into your general ledger on that day, the 31st. You then put the checks back in your desk drawer and you brought them to the bank a couple of days later. In the meantime, the bank statement was prepared. So those checks that have been prepared but not on their way to but not in the bank yet, are called deposits in transit, which we're going to learn about. And in this little example here, the balance in the deposit books would be more than 6,000 than the bank. You debited cash, but the bank didn't get it until May 1st, which is after they prepared the bank statement. Two important terms to understand: deposits in transit and outstanding checks. Deposits in transit, those deposits that have not reached the bank or been recorded by the bank at the time of the bank statement. Deposits in transit are checks you received from your customers. You got a check in the mail today on July 31st, and you debited cash and you credited accounts receivable, and then you didn't mail the check to the bank for another week. In the meantime, the bank statement came out, so that check is not going to be there. That's a timing difference, and it's called a reconciling item. So deposits in transit are checks that our customers wrote that are in transit. Outstanding checks are checks that we wrote, the company wrote. They've been issued but not presented to a bank for statement before the bank statement is prepared. Outstanding check. It used to drive my accounting manager crazy many years ago when she would prepare the bank statement, and there would be like 10 checks that were 3 or 4 months old and still not cashed. An outstanding check. A salesman goes on a trip and he turns in his expense report, and it turns out we owe him $3. So the system prepares a check for $3. He put the $3 in his wallet and forgets about it for a few months. That's an example of an outstanding check. And the bank will have service charges on it. It could be interest. It could be a fee for printing new checks. It could be a lot of different things. It could be interest expense. So these are 3 timing type differences. Let's talk about a few more. Collections. You loaned money to some people and they pay you by direct deposit. Well, if you get a direct deposit, say toward the end of the month, you may not know about it. You may not know about it until you get the bank statement and you go, hey, look, Smagula finally paid us. That is an example of a timing error where something is on the bank statement and you don't know about it. So banks can make collections on our behalf. A non-sufficient funds check, NSF, check deposited but not paid because the drawer did not have sufficient funds. It's a bounce check. You know what that means, a bounce check? You wrote a check even though you had no money in your checking account. The money was presented at the bank and the bank kicked it back. You may not know about this until the end of the month, and you have to treat that as a reconciling item. And errors made by the bank or by the depositor in recording cash transactions. On your test, and hopefully in most of the homework assignments, the errors are going to be made by the company, not the bank. Okay? Bank errors just don't happen. If there's an error, we're the ones who are going to make it. Okay? So now we're preparing the famous bank reconciliation. And I hope you guys become experts on this, okay? It's super important. And this might sound a little bit silly, but you go, maybe after 2 years here, you get your AA degree, and maybe you hopefully transfer to a four-year school, but you're looking for a part-time job, and you find out that there's an office opening. If you tell them that you can prepare a bank reconciliation, that is very impressive. In the real world, some people never really learn to do the bank reconciliation efficiently. It's a nice skill to have as you're coming out of school. So the steps in preparing the bank reconciliation. Well, we got to figure out the outstanding checks. We got to figure out the deposits in transit and any other reconciling items that we pick up from the bank statement. So step number one, identify the deposits in transit. Compare the bank statement and you look at every single line item under deposits. You check them off the bank statement and you check them off your general ledger. And if it's not there, it is a deposit in transit. Okay. Individual deposit amounts in the accounting records. If they differ, something needs to be corrected. We need to record what the bank is telling us. So first step, deposits in transit. Next step, you do the same thing with the outstanding checks. You go down the list of all of your checks in your general ledger, one by one. You compare them to all the checks in the bank side, cross them off. What's uncrossed becomes your outstanding checks. Check mark the stub or accounting record to say that it's cleared. Checks written but not cleared the bank are outstanding checks. And on the bank reconciliation, they're going to be subtracted from the bank balance. Other reconciling items. Compare any additions and deductions on the bank statement we don't know about. There could be all kinds of things, what they're calling here credit or debit memos. But what we're talking about are collections on account. One of our customers paid us electronically, and now we're just learning that. A bounced check, that would have to be deducted from our cash, right? A bounced check, that's money we thought we had, but we don't. We could have interest income, we could have interest expense, bank fees, all kinds of things. Here is a simple example of a bank reconciliation, okay? Bank reconciliation. So let's see here. We have a bank reconciliation. They're saying $637.02 recorded on November 21st had not been received by the bank, huh? The one thing they're not telling us here is what the balance in the bank is, nor the balance on the general ledger. They will do that when we get to the actual grid, but they should tell us now. So we have a deposit of $637.02. We put it in our system on November 21st, but then we got the November 30th bank statement and it was not there. It was not there because it was still in the mail, apparently. Check number 219, 224, and 227 are outstanding. How do we know that? We took our bank statement, we took a copy of we printed out the general ledger account cash, and we checked off all of the check numbers. And these are 3 that were still in the mail to the bank. Check number 214 was written for $18.98, but was entered on the check stub in the books as $19.88. Okay, so what happened here was we actually physically took a pen and wrote a check for $18.98, but we recorded it as $19.88. In any modern system, that's probably not going to happen. Not too many handwritten checks these days. So let's take a peek at, let's look at our statement here, our bank rec, and see what we have. What I'd like you to do is look at this template. If you write the template down without any of the numbers, you're halfway there, okay? The template is always the same. The template says, take the balance per the bank, which they're now telling us, 174809. We had this deposit in transit. They just told us about the 63702. They told us checks 219, 224, and 227 are outstanding. So what we're telling the bank on paper anyway, we're saying, hey, bank, you don't have this 63702 deposit, nor these three checks, which total 290,278. So we think the proper bank balance, the adjusted bank balance, is 2,092.33. Okay. Let's go back up a slide. So those first three, the outstanding checks, the deposits in transit, and our mistake are things that we learned from going through the bank statement. We're telling the bank things they don't know. Look at number 456 here. Maple made an ATM withdrawal of $100, but they never recorded it. That can happen pretty easily. The boss is walking around with an ATM card, and he or she goes to the bank one day, takes out $100 to take a customer out to lunch, and never tells anybody. Well, we now have the bank statement that says there's $100 missing. After we verify it with the boss, we're going to have to deduct that from our bank balance, our book balance. Bounce check came back. A bounce check. Oh my goodness. When we got the payment from this guy, we debited cash, but the bank says, no, there is no cash there. So we're going to have to reverse that. And then there was a bank fee of $1.80. So let's take a peek. Let's take a peek. Peek, peek, peek. Come on, I want you to. It's not peeking. So look at the other part of the template. Book balance, or the checkbook balance, was $2393.20. We had that error on the check, the 1980 that was written instead of 1890. It turns out we had 90 cents more than we thought. Hooray. And then we had an unrecorded ATM. The boss went to the ATM machine. We had a bounce check we're just learning about, and the bank charge was $1.80. So we take the beginning checkbook balance and we add in all the pluses, we subtract out the deductions, and we should come up with the same number, 209,233. Once we've accomplished that, once the bank reconciliation jives is reconciled, we can take a deep breath because we have just verified that we can account for every single penny that floated through our system through this past month, okay? Very important internal control doing the bank reconciliation. The auditors love to look at the bank recs. When they come into your business, they'll assign somebody to monitor the cash. They're going to look at your general ledger. Your general ledger says that you have $2,393.43. And then they're going to say, let's see where that money came from. They're going to look at your deposits and everything. And then most importantly, they're going to verify and probably redo your bank reconciliation. Now, once we prepare the once we prepare the bank reconciliation, we're going to have to prepare journal entries. We will prepare a journal entry for each item on the bank statement that we don't know about, okay? The bank reconciliation, when you think of it, consists of us telling the bank what they don't know and the bank telling us what we don't know. What the bank tells us is going to result in journal entries. I take us back to reconciliation. You will never, never have to write a journal entry for anything on the bank side. Okay, so get that out of your skull right now. Bank statement balance, you do not ever write a journal entry for these numbers because these are the numbers we know that we're telling the bank. We've already recorded them. Look at the book side. That's a different story. There are 4 things here that we have not recorded. Each one of those requires some kind of a journal entry. I'm not going to call it an adjusting entry, but a journal entry. Only 2 kinds of items appearing on the reconciliation require journal entries. Errors we might make and bank additions and deductions that are not always already there, okay? All items on the book balance section require a journal entry. So when you're taking the test, you're going to get questions along the line. Outstanding checks were $1,000. Deposits in transit were $2,000. And bank fees were $50. What is the proper journal entry? Well, you're going to understand, hopefully, that there's no journal entry for the deposits in transit, nor for the outstanding checks, but that $50 bank charge, that requires a journal entry. Debit bank fees, credit cash. And let's look at the journal entries that we're going to be writing. Remember the first one, this 90-cent difference. Assume $18.98 was in payment of an account payable that had been incorrectly debited for 1988. Well, we wrote the check for $18.98. But when we recorded it in our system, somehow we typed in 1988. So we took too much money out of our account. Bank statement comes and we look and we go, oh my goodness, that's not 1898, it's 1988 or whatever. So this results in a 90-cent gain back, if you will, of cash. We're going to debit cash and we're going to credit probably accounts payable because when we made the payment, we debited accounts payable and credited cash, okay? Notice that cash is one of the accounts in this journal entry. Every single bank reconciliation journal entry is going to have either a debit or a credit to cash, okay? You can't have a bank reconciliation journal entry that doesn't have the term cash in it. Let's see, the $100 ATM withdrawal has been deducted from Maple's account by the bank, but Maple, we haven't recorded it yet. That's because the boss stuck it in her wallet and never told anybody. So we find that $100, we call up the boss, James Maple, I guess. You say, hey boss, what's that $100 you took out on the 25th of the month? And he'll say, oh, I'm sorry, I forgot to give it to you. That was a withdrawal. So you debit drawing and you credit cash. If he said he took a customer out to lunch, well, then you know it's a travel expense or entertainment expense or meals or something like that. The bounce check. And believe it or not, this happens in the real world. Nothing more embarrassing than bouncing a check. Most embarrassing, I mean, I never really bounced them except this one very embarrassing time. I was living in North Carolina and I moved back to California again. And I wrote a check, a fairly large check to a good friend's daughter for her wedding. And the check bounced. And the reason was she kept that check for like a month and a half. In the meantime, I closed my North Carolina bank account. And that was kind of embarrassing, but a bounce check. The NSF check was deducted because it's worthless. So what is the adjusting journal entry? Let's think our way through it. When we received the money, we debited cash and credited accounts receivable, right? Now we find out that this customer's a bum. So we have to go back and put him or her back on the aging with a debit to accounts receivable and a credit to cash, okay? Oop, we had a bank fee, $1.80. Wow, $1.80. Okay, we look at the bank statements and we notice the bank took this $1.80 out of our account. Well, we just have to record the reduction of cash. And they're debiting an account called miscellaneous expense, which could be right. More likely, you'll have an account called bank fees or bank charges or something like that. Electronic banking, I think we know electronic banking. I'm not going to go into that. So that's a look at a bank reconciliation, okay? Let's talk about a couple other things here. Establish and use a petty cash fund. Petty cash. Those of you who are out in the workforce, perhaps in an office, have what's called petty cash. Petty cash is a small amount of money set aside to pay the daily little nits and gnats that might come up, okay? The mailman comes and says, you owe me 50 cents in postage. An employee comes up from the factory and he says he lost $1 in the Coke machine. These types of things. So a petty cash fund is typically $100, $200 perhaps, maybe more. And it consists of coins and bills at the beginning that are put into an actual box of some kind. So the petty cash fund gets established by writing a check to the petty cash custodian for the amount. And the custodian cashes the check and puts the money in the petty cash box. In other words, if Vanessa was in charge of petty cash, the check would be written personally to Vanessa. Vanessa takes it to the bank and she tells the bank, give me some 20s, 10s, 5s, 1s, and a mixture of coins. She brings that back to her desk, locks it in her desk drawer, and is open for business. And only the custodian, only Vanessa should be able to touch that money, okay? At all times, the petty cash fund has to equal, say, $200 or $100. So Maple wants to establish a $100 petty cash fund to be used to make small purchases. So we have to set up a new account, and you're seeing a new general ledger account for the first time. It's called petty cash, huh? We're going to debit petty cash and credit cash. Explanation to establish a new petty cash fund, okay? So that $100 is now sitting inside somebody's desk, locked away, hopefully. Now, somebody comes to get paid with petty cash. And here we have a petty cash receipt or chit or voucher, whatever you want to call it, for a guy named James Maple, our president. He took a client to lunch, client luncheon. He is asked to fill out this voucher and the amount and everything. And typically, he'll give a copy of the cash register tape or the check or the bill from the restaurant to attach to the voucher, so we know it's good. And the petty cash custodian will then hand him $25.75 in cash. So you're trading $25.75 in cash for a voucher of the same amount. Therefore, the petty cash account in this case still equals $100. Cash plus vouchers must equal $100. And a voucher like this, a receipt, is prepared for every payment from the petty cash fund. Very typical. Any business I've been working for, there's always a petty cash drawer, okay? You don't want to tell the postman who wants his 50 cents, come back next week when we run checks and we'll hand you a check for 50 cents. You could do that if you wanted to be super anal, but typically you need to make these payments quick. The UPS guy shows up. That's a classic. Guy shows up with a delivery. He wants his $9, a COD. So petty cash. And then there's a multi-column record that supplements the regular accounting records. And you'll see this in your homework. It's not too terribly tough. It starts off with the beginning balance of 100, and then there's a column for the increases in petty cash and the decreases, along with the coding. So petty cash has a report called the petty cash report. Now it's time to replenish petty cash. The month has ended and we've only got a few dollars left in petty cash. It's all vouchers now. So you replenish petty cash when the fund runs low, or hopefully at the end of the accounting period. One question I still recall from the CPA exam many years ago, a question was, which of the following items indicates that your petty cash is screwed up? And one was you're writing vouchers, and two, you're locking the money up, and three, you're always in balance. So those were obviously good ones. The answer was, if you're replenishing the petty cash more than once a month, you have a problem. You have a problem. If you're replenishing petty cash more than once a month, it means one of two things. Your petty cash fund is too low for the type of business you have, or you're paying items that are too big through petty cash. And you'll get a little whining sometimes from an employee. The employee goes out and spends $65 out of his own pocket for something. Well, on a $100 petty cash fund, you're not going to hand that guy 65 bucks probably. You're going to say, I'm sorry, John, you're going to have to wait a couple of days till we do run the checks, okay? So the petty cash is meant to last for a month. And how do we replenish it? Well, the first thing we do is prepare that report, and we're going to debit all the expenses on that report. We're going to debit all the expenses, and we're going to credit cash. Okay. Then we're going to make sure that the vouchers plus the cash equals the $100, and we're ready to replenish. We're going to write a check payable to Vanessa. She's the petty cash person here. We're going to write a check personally to Vanessa. She's going to run to the bank and put the money back into the petty cash account. Okay. Let me make one other point here. Once you debit petty cash to set up the petty cash fund, you will never touch petty cash again. You'll never debit it again, okay? The only time you'll ever touch it again is if you increase the amount you want in the petty cash, all right? So here we go. At the end of the month, the petty cash fund had 8 vouchers, and there was only $11.20 in cash there. So the difference between that and $200 is $188. So now you have all kinds of expenses from your petty cash report that consist that total to the $188.80. We're going to write a journal entry now. We're going to debit all of the expenses, and we're going to credit cash. So let's take a look at this. From your petty cash report, we see that we had automobile expense, postage, travel, miscellaneous, and drawing. We're debiting these various items, and notice we're crediting cash. We're not crediting petty cash. Only time you touch petty cash is when you set it up. So we're crediting cash, and we're going to take that to the bank and start the cycle over again. Let's talk about something called the change fund. Change fund. I'm sure we have people in the class who've worked in a retail or store or restaurant or something, and they ran a cash register. Okay? Cash register. The change fund is a cash register amount. It's the amount of money that is in the cash drawer at the start of the day. For example, this restaurant starts the day with $200 in their cash drawer, and then they start doing business. At the end of the day, you check out your information, your cash register tape perhaps, and you record the revenues that day. After you do that, you subtract the $200 and you're back to the $200 beginning. So let's take a look here. Change fund, supply of currency and coins kept in the cash register, and it allows businesses to make change at the beginning of the day. At the end of the day, the cash received during the day is deposited. Hopefully it's deposited. We talked about that a little bit earlier. Hopefully you deposit it every day. You don't wait until the end of the week when some disgruntled waiter can come back knowing all the money's there and knock the place off. So the change fund, the $200 is held back for the next day. So you deposit everything except the $200, right? And look at your journal entry. Isn't that easy? You set up a change fund just like you set up a petty cash fund. So suddenly in Chapter 7, we have 3 cash accounts. We have cash, regular cash. We have petty cash, which will always be $100, and I think in our example here, and this change fund, which will always be $200. Just like petty cash, you're not going to touch the change fund again unless you decide you need $300 all the time. So let's see here. The day has ended. The day has come to an end, and there is 1,450 in the cash register. The cash register. The cash from sales should agree with the sales recorded on the cash register tape. So the cash in the drawer was $1,450. We subtract 200 because we're always keeping that aside. So that means that on this particular day, our cash increased by $1,250. We started the day with 200, and now we have $1,450. So the cash sales were $1,250. And look at that journal entry. You debit cash and you credit. They're calling them service fees here. I don't know why they're calling them service fees, but you call them revenues, service income, okay? You debit cash, you credit service fees. That particular time, they were in perfect balance. Well, what if you're out of balance? Those of you who've worked the cash register know it's almost impossible to go day after day without some kind of a mistake. Hopefully the mistakes are small, and some of them will reverse the next day. You might notice you'll be off $5 this day low, and the next day you're $5 high. So we have an account to record the difference that we're off, and that account is called cash short and over. Okay, so this is another new general ledger account, and mistakes making change lead to errors. Very easy to make a mistake. I always leave pennies behind when I go to a store. If I get 4 pennies in my change, I just drop it on the counter. That's going to throw them off. Okay, so mistakes making change leads to errors. So again, we're going to take the actual cash, compare it to the daily sales total, and we might be over or short. Okay, if we're short, we're going to have to debit an expense called cash over short, or we're going to credit it. So let's take a look at what we're talking about. In this example here, there is $1,161 left in the cash register. The cash register tape shows sales of $963. So, okay, let's see here. We have $1,161 in cash sitting here. 200 was there this morning. So our sales were $961. According to the arithmetic here, but the actual sales were $963. The cash register tape is the gold standard. Whatever the cash register tape represents your sales. So here, you're going to debit cash for $961. You're going to credit sales, or what they call service fees here, whatever. You're going to credit this number for your revenue. The difference of $2 is cash over short. Okay, you debit cash for the change in the cash register. You credit the service fees for whatever the cash register tape says the sales are, and the difference is cash short or over. In this case, you're short. You are short. Let's take a look at another example. Now we're over. We start the day with $200, right? We subtract that from what's in the drawer at the end of the day. According to the sales, we had sales of 815. Let me start again. According to the dollars, the cash from sales was $815. Cash went up by $815, huh? We know that. But the cash register tape said we only had sales of $814. The difference of $1, again, is going to be recorded against the account called cash short and over. Only this time it's going to show up in the form of $1 on a credit side. Credit. We were over. Okay. So that's a look at 3 items here. Bank recs, which is what I really hope you learn real well, and the petty cash and the cash register tapes, okay? Typical things businesses do. Let's talk a little bit about internal controls. I'm just going to go through this fairly briefly. It's kind of super important as we go along with the class and in Accounting 230 and other courses you take. Internal control. Done correctly, they assure reliable records, assets are maintained and managed properly, and the rules and procedures are being followed by the employees, and they provide accurate information. Here, write this down. Sarbanes-Oxley Act, huh? SOX. Same way the Boston Red Sox and White Sox spell it, right? Sarbanes-Oxley Act. This applies to all publicly held companies. It requires annual reporting on the effectiveness of the internal controls and resulted in many non-publicly held companies evaluate their internal control. What we're talking about here with Sarbanes-Oxley, it came out of a scandal called Enron. You may or may not have heard of Enron Corp. When you have time, not right now while you're busy at school, but Google Enron. It was the largest corporate fraud in American history. It ruined the lives of many, many people, and it even killed people due to some of their malfeasance, believe it or not. I'll go into detail some other time. But at that time, they were handing out phony financial statements that were totally false, and using that to bump up the stock price and raise salaries for the big bosses. And at that time, the chief officer of the company, the CEO, he could throw his hands up in the air and say, hey, I'm not the accounting guy. I don't know what where these numbers came from. And he would be pretty much exempt. So now, after the top management of that company went to jail and the business totally collapsed, Sarbanes-Oxley was an important law passed that now says, if you're the boss of a company, you better know what the numbers are. You can't just say, I don't know. Internal control, developed by a company to provide reasonable assurance. You control the environment, the risk, activities. Control environment, the structure, the management philosophy. Yeah, a lot of companies have statements of what their values are, what their ethics are all about. You commit to competent, trustworthy employees. You assess risk, huh? You worry about errors, fraud, obsolete inventory, all kinds of things. Some risks they're talking about are errors. Yeah, if you're making a lot of errors in your accounting system, there's a problem. Fraud, if you find out that I've been stealing from the company for a long time, that is a bad indicator. Old inventory, that needs to be written off and analyzed. And if you have a lot of turnover in your company, that's usually a bad sign. Okay. Here are the duties that I really want to pound at you a little bit. They're talking about 4 kinds of control activities. Segregation of duties, huh? Segregation of duties. Remember the bank reconciliation? Well, the person who prepares the bank statement or the bank reconciliation should be a different person than the one who records the numbers in your general ledger. And a third person should be taking the money to the bank, and a fourth person should be opening the mail. When you bring more than one person into the loop, you minimize the possibility of fraud. If you have just one person, you're asking for trouble. And I'm going to take a minute to tell my favorite story, which is true, about a woman from Santa Barbara who got out of high school. She went to work for the police department as a clerk. And over the years, she excelled. She did nice work. She kept getting promoted. And eventually, they gave her a big responsibility. And that was to take care of everything that has to do with traffic fines. So they said to her, Marie, we want you to collect the money, enter it into the system. You know, you're in charge of the computer system too. She was an honest woman, but they set it up to make the stealing so easy, she couldn't resist. And what would happen would be, I would get one of those $40 annoying parking tickets on Shoreline. I'd mail my fine money into the police department. She would get my check, go into the computer system, which she also was allowed to run, and she would delete my ticket like it never existed, and then put the money in her bank. She went on to steal six figures, hundreds and hundreds of thousands of dollars over many years. That's an example of a terrible, terrible internal control where the duties were all put into one person. You could be the most honest person in the world, but if you're given that kind of temptation, it might be tough. Segregation of duties, what we're just talking about. Segregate the duties, split them up. Every activity needs to be authorized. You want documents. Your invoices are pre-numbered, huh? Invoices are pre-numbered. Checks are pre-numbered, so you can keep track of them. Cash, you have vaults, right? You put the money in the vault at the end of the day. You just don't stick it in an open desk drawer, okay? And I'm just skipping through the end of this here. Controls over cash receipts. All cash received by the business is recorded, promptly deposited. Cash register, you protect your cash receipts from customers with the cash register tape. Only authorized employees operate registers. You don't have a person come on the job at 8 in the morning, and then he or she works for 3 hours, and they go on a 1 hour break, and someone just steps in to replace that person without restarting the adding machine tape again, starting all over again. Registers are important. Boy, look at all these things. Mailroom should be supervised. My goodness, look at all this. I just like you to look over this section. The bank reconciliation prepared monthly, and any differences should be investigated. If your bank statement says that you should have, if the bank statement says you have $100,000, let me put it this way. If the bank statement says you have $100 and you do the bank reconciliation and you think you should have $100,000, you've got a super big problem, okay? It could mean somebody stole money. Without the bank reconciliation, you might not have known that for quite a while. Internal control over cash. You don't have a lot of cash lying around, okay? You're not going to worry about this. So anyway, that takes us to the end of our lecture. Just racking this up to the beginning here. Okay, chapter 7, we covered cash. The only thing I didn't go into real detail on is the petty cash. And I have to make up a couple of slides to do that, but that's not a difficult assignment. Anybody got any questions, any comments? Nobody has anything to say, huh? Hold on one second here. Hold on. All right, well, I guess we'll let us go then. You guys take care. And don't forget, we have our magnificent Wednesday hangout in front of the accounting building And Cornelia's not going to be there. She's back in Europe for a while, and she wants me to run this thing. So if you want a couple of free sandwiches, say hi to me and a few other people. Come on down Wednesday, 5 o'clock. Okay. Take care, everybody. Bye-bye.
Thank you.
Thank you. Good to see you all.